Welcome to Money and Markets Series 1, Lesson 6. This episode is called Why Your Loan Costs More Than Your Savings. Here is a fact you have probably noticed but never stopped to measure. You walk into your local bank with $10,000. You open a savings account. The bank offers you 3% per year. Simple, safe, insured. Now imagine the same day you borrow $10,000 from the same bank. The bank charges you 7.5% per year. Same bank, same person, same amount, but the two rates are not even close. The deposit pays you 3. The loan charges you 7.5. That gap between what the bank pays you and what the bank charges you is the subject of this lesson. It is not random. It is not a mistake. And it is not purely greed. There is arithmetic behind it, and once you see the arithmetic, you will never look at a bank statement the same way again. Let us run the numbers side by side. We will use simple interest to keep things clear. You deposit $10,000 at 3% per year. At the end of 1 year, you earn $300 in interest. That is your reward for letting the bank hold your money. Now the other side. You borrow $10,000 at 7.5% per year. At the end of 1 year, you owe $750 in interest. That is the price you pay for using the bank's money. The difference is $450. That $450 does not disappear. It goes to the bank. It is the gross margin between what the bank pays for its raw material, your deposit, and what it charges for its product, the loan. Think of it this way. A bank, like any business, needs to charge more for its products than it pays for its raw materials. Deposits are the input. Loans are the output. The spread is the margin. Now the extreme case. Credit cards. Borrowing on a credit card can cost about 18% per year. And if you have a poor credit history, it can be even higher. Let us put that in the same frame. $10,000 at 18% using simple interest is $1,800 per year in interest. Compare the three rates on screen. Deposit, 3%, $300 earned. Bank loan, 7.5%, $750 paid. Credit card, 18%, $1,800 paid. The credit card rate is 6 times the deposit rate. 6 times. On the same amount of money. Why so high? Because credit card lending is unsecured. There is no house, no car, nothing the bank can seize if you stop paying. The bank is absorbing more risk. And risk, as we have been learning since Lesson 1, has a price. The higher the risk the bank takes, the higher the rate it charges. That principle shows up everywhere in finance. Now step back and see the bank as an institution. A bank sits between two groups of people. On one side, depositors, many of them, each putting in money they do not need right now. The bank pays them a modest rate, and in return, it has a pool of funds to work with. On the other side, borrowers, people who need money now and promise to pay it back later. The bank lends to them at a higher rate. The bank is a matchmaker. It connects people who have money but do not need it today with people who need money today but do not have it yet. Banks perform and provide many financial services. Those services cost money. Staff, technology, branches, compliance, insurance, reserves. All of those costs live inside the spread. So when you see 3% on your savings and 7.5% on your loan, part of that gap is the bank's operating cost. Part is the risk of lending to people who might not repay. And part, yes, is profit. We will break it down in the next scene. 5 reasons the spread exists. Watch them appear on screen one at a time. Number 1. Operating costs. The bank has employees, buildings, technology, and regulatory compliance to pay for. Those costs must come from somewhere. Number 2. Default risk. Not every borrower repays. Some loans go bad. The bank prices that expected loss into the lending rate, so the good borrowers effectively subsidize the ones who default. Number 3. Maturity mismatch. The bank takes in short-term money, like savings accounts you can withdraw anytime, and lends it out long-term, like 30-year mortgages. That timing gap creates interest rate risk, and the spread compensates for it. Number 4. Capital requirements. Regulators require banks to hold reserves against potential losses. That capital has a cost, and the spread covers it. Number 5. Profit margin. After costs, defaults, mismatch, and capital, whatever remains is the bank's profit. Without it, no one would run a bank. These 5 pieces together explain the gap. It is not a single cause. It is a system. Here is the simplest picture of how a bank works. A cartoon balance sheet. On the left side, assets. These are the bank's loans. The money it has lent out at 7.5%. This is where the bank earns its revenue. On the right side, 2 sections. First, liabilities. These are the deposits. The money the bank owes to you and every other depositor at 3%. Second, equity. The bank's own capital, the cushion that absorbs losses if loans go bad. The spread, the gap between 7.5 on the left and 3 on the right, funds everything in between. Operating costs come out of the spread. Default reserves come out of the spread. Regulatory capital requirements come out of the spread. And profit, if there is any left, comes out of the spread. This is a simplified picture. But the mental model matters. Every time you hear bank spread, you should see this T shape in your head. Assets on one side, liabilities plus equity on the other. The gap between the rates is where the bank lives. The spread is not fixed. It moves. 3 things push it wider or narrower. First, the credit cycle. When the economy slows and recession fears rise, banks widen loan spreads because default risk goes up. Even if the central bank cuts policy rates, the rate you pay on a new loan may not drop as fast because the bank is pricing in more fear. Second, competition. When neobanks, money market funds, or fintech apps offer higher deposit rates, traditional banks face pressure to raise what they pay savers. That squeezes the spread from the deposit side. Third, regulation. When regulators increase capital or liquidity requirements, the bank's hurdle rate for new loans goes up. More capital tied up means the spread needs to be wider to cover the same return on equity. All 3 forces interact. A recession with tight regulation and fierce competition can squeeze bank profitability from multiple directions at once. None of this is abstract. It is the reason your savings rate and your mortgage rate do not move in lockstep with the central bank's headline number. Is the spread fair? That is not quite the right question. The right question is, what part of the spread is arithmetic and what part is market power? Some spread is unavoidable. Banks have real costs. Borrowers do default. Capital must be held. Maturity mismatch creates genuine risk. All of that requires compensation, and that compensation comes from the spread. But some spread may also reflect limited competition or opaque pricing, or the fact that switching banks is inconvenient enough that customers accept worse terms than they should. Both hypotheses belong on the table. At the same time, no one can tell you exactly which fraction is which. That depends on the market, the product, and the moment. What matters is that the spread is a structure, not an accident. The practical takeaway is disclosure and competition. Read your rates. Compare offers. Understand that the poster rate on a savings account and the rate on a loan application are 2 views of the same institutional math. And that math is negotiable more often than people think. One more piece before we close. The maturity mismatch. Banks typically take in short-term money, like savings accounts that you can withdraw at any time, and lend it out long-term, like mortgage loans that run for 20 or 30 years. That mismatch is structural. It is how banking works, but it creates a risk. When short-term rates spike, the bank's cost of funding rises immediately, but the income from long-term loans is locked in at whatever rate was set when the loan was made. The bank gets squeezed. This is exactly what happened in several banking crises. Short rates rose, deposit costs jumped, loan income stayed flat, the spread collapsed, and some banks could not survive. Term to maturity is one of the primary influences on the interest rate. We explore it fully in the next lesson. That is Lesson 7. Lockup periods, maturity, and the term premium. The idea that longer commitments carry higher rates, because time itself is a source of risk. 3 takeaways to carry forward from this lesson. 1. The bank spread is the gap between what a bank pays depositors and what it charges borrowers. In our example, that is 3% versus 7.5% on the same $10,000. The gap funds the bank's costs, reserves, and profit. 2. 5 forces drive the spread: operating costs, default risk, maturity mismatch, capital requirements, and profit margin. None of them is the whole story. All of them interact. 3. The spread moves. The credit cycle, competition, and regulation all push it wider or narrower. Your savings rate and your loan rate do not track the central bank in lockstep, because the spread is a living number with its own dynamics. Next lesson, we ask why locking your money away for longer usually earns you a higher rate. Lockup periods, term to maturity, and the premium the market pays for patience. I will see you in Lesson 7.